Alright, so I'm over at Forbes.com right now, and the article title is China Surprise Rate Cut Signals Desperation. Bad News Ahead. And this is by Gordon Chang at Forbes.com. In a move virtually taking everyone by surprise, the People's Bank of China on Friday announced a cut in the one-year benchmark lending rate of 40 basis points, the first reduction in more than 2 years. The central bank also lowered the benchmark one-year deposit rate by 25 basis points. Both changes were effective yesterday. And it talks about some optimism in the marketplace, but we know that's phony. But let's read this paragraph. Yet the optimism was misplaced. Friday's announcement reveals troubling trends in China's economy and even its political system. Going forward, do not expect good news coming out of the country, perhaps for years. I totally agree with that assessment. And I want to go a little more into the stress that's going on in China's marketplace right now. But before I do go into that, I do want to look at what I was talking about last year, where I definitely figured out, hey, there's some problems going on which the mainstream media really isn't covering. And we could go actually to this graph here. This is China's 7-day repo market, and I was doing videos probably a year ago, and I was saying that, hey, guess what? China's 7-day repo market rates are going up. What does that mean? It means that there's stress in the credit markets, or there was stress in the credit markets. Long story short, there's a fractional reserve banking system that we have, right? They take short-term cash and they roll it over into long-term illiquid securities, right? So the thing is, if rates are low or at its norm, then there's no problem in financing these long-term illiquid securities. The problem is that if you can't roll over your short-term debt, how on earth are you going to finance your long-term liabilities? So this is the problem that China was facing last year. And then December of last year, they also faced a similar situation. Then central bank intervention, voila, everyone forgot about it, right? Green shoots ahead. However, if you look at the surface, what does that tell you? It tells you that there's a solvency problem, and you can't paper over a solvency problem. Sure, you could do it in the short run, but long term, the free market will definitely come back to bite you in the rear end, because the system is over leveraged. That's what the market was telling us last year, or these repo markets. That's what they were telling us. And I've showed a similar type of graph in the past, and what I always wanted to talk about is how in the United States we saw a similar situation where the credit spreads actually blew up. This is Lehman 2008. But before that, in 2007, before this crisis blew up in August, the spread between the LIBOR and OIS spread was only 10 basis points. And then all of a sudden, if you go out to October, around that time frame, 2008, when Lehman was already bankrupt, right? The spreads went to 350 basis points. So that meant that the system had a cardiac arrest. And when it had a cardiac arrest, boom, shakalaka, right? And I also have this other graph here. So I chronicle how the Fed funds rate went from roughly 5.25, right? It was around that range, if I remember correctly, in August 2007, then all the way going back to 2008, or moving forward from 2007 to 2008, in November of that year, Fed funds rate practically went to zero when QE1 was announced. And what I noticed was that Fed funds rate went down. Markets initially went higher. If you look at the October high, 14,100, 14,200-ish, right? But then, as Fed funds rate continued to go lower, right? You had more inflation, you had stock market going down further, and it went down close to 8,000 in November 2008. And that happened when everyone thought that, hey, cutting these interest rates would be bullish for the market in general. Okay, so we look at this graph over here. We are at least 5 years into the bull market recovery, especially for the United States. More than 5 years, 5.5 years, right? People saying, hey, it's only a stock market rally, there's no rally going to Main Street. I totally agree with that assessment. That being said, 5+ year rally in the marketplace, and now we could look at this Chinese interest rate PBC long-term graph. And this is what interest rate I was talking about before, right? Interest rates were 6% going back to 2012. And now it's going to be lowered to roughly 5.6%, okay? Last time we saw rates go down, it was in 2008, 2009, right? From 7.5% going all the way down to like 5.25%, around that range, okay? And then rates started to go back up in 2012. They had a rate cut in the middle of 2012, and then rates have been constant since 2012-ish. So now it's actually lower at 5.6%, like right here. So remember this graph that I just showed you here, right? Initially markets went up with this rate cut, right? This is 4 or 5 years into the bull market recovery under Bush, right? And then all of a sudden rates started to go down slowly for the 1 year. In China, I think it's going to be for a few years before the next US presidential election, then boom shakalaka. And then you'll see, in my opinion, the US equity market get creamed as well. So initially could be bullish, just like in the United States, but then what do I see? Rates go even down further. That means that there's more stress in China. So I feel that the Chinese stock market is going to go down, right? The only difference, if you look at the US Ponzi versus the Chinese Ponzi, is that if you go to here, right, this happened fast within a year. This is the United States LIBOR OIS markets, right? Over 1 year, it took for the markets to crash, right? In China, it's a slow crash, in my opinion, right? And some people are saying that it's a slow equity crash as well. So this is what I'm thinking right now. Once again, do not invest based on what I'm saying, right? In the short term, markets could go up, right? And that's what we're seeing actually in the US stock market. So what I'm saying is just use this for educational purposes, and if you are going to invest in the equity market, remember there's a lot of risk out there, so make sure that you are hedged and you could sleep at night and don't concentrate too much of your wealth in one side of the trade, right? That's the only thing that I could advocate, is just make sure that you could sleep well at night knowing in what you invest. And if you have to liquidate, well, just make sure that you are diversified to the way that you see it, okay? That's the only thing that I could say legally. Anyways, guys, thanks for listening to me. I'll talk to you later. Leave your comments below. Bye.